Every time we've seen this signal, it means that central banks around the world are about to pivot in policy. Hello, ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities, and cryptos. We'll be discussing the FOMC meeting statement coming up and the 25 basis points that's expected to be hiked. But more importantly, we'll be talking about the key levels that will matter to you over the next coming days, months, and even weeks. Yes, it seems like the central banks have done it again. They've broken the system, and now it's time for them to support it. But will they? Let's take a look together right now. Well, welcome back everyone to the Daily Show where we talk about markets around the world. If it's your first time here, welcome. Click the subscribe button. Of course, smash the like if you find value in today's content. But we'll be talking about the macro lead news, hottest levels on the charts, and everything is coming your way very soon. Let's begin with the news stories though. Don't dream it's over, says one of the top JP Morgan strategists, and they're warning of course, potential concerns in the markets. Why could this be? Well, the new hottest word in the market at the moment is systemic credit events. We've seen central bank policy move towards basically injecting tons of capital into the markets, which we'll be looking at some charts that we shared over on Twitter very soon with. And this is now the big story. Inflation staying high is now, let's say, not at the forefront of the market's thought processes. Just remember, though, whenever the central banks around the world begin these particular tapering style concepts or raising of rates to try to reduce the liquidity out there and to cool inflation, in the end, what ends up happening is you don't beat CPI, that is inflation, until they push the central bank funds rates above the CPI number. At least that's how history has worked. Now, we know that we're only a few hours away now from the new rate hike expectations, and you can see here that most economists believe we're going to get a 25 basis point rate hike. This is 86.4% of people, and there's been some drastic shifts, as we know, over the last couple of weeks. If we took this to 2 weeks ago, we would have seen around 80% of people thought there was going to be a 50 basis point hike. Everything's changed, and that's how fast things can happen. Like a click of a fingers, it can be very, very quick. I'd just like to remind everybody I'm starting to post a few great charts over on Twitter as well. So if you're interested in some of the key levels that we're looking at right now in markets, I've posted a quick US 500 chart ahead of the FOMC event with some watch reaction levels, as I believe this could be a liquidity steal kind of concept. We've got unfilled gaps and other things we'll be talking about later. Now, if we scroll down through here, we shared some Fed balance sheet spikes the other day. My belief is that the Fed really is the market at these stages. Whenever we're seeing huge liquidity in, it tends to bring asset appreciation. Specifically in technology stocks, they tend to do very well off this Fed balance sheet. But you'll notice I've got a different version here that I use. And if we scroll up, that's actually started to turn. So what this means is that liquidity is starting to quickly come back out of the system, and that's because it was a huge knee-jerk reaction. Now they're pulling it back a little bit to try to stabilize it. If this continues to go down, which I will update you here, so make sure to subscribe, and we see the markets continuing to rise, it's a good chance the markets are about to turn. Similar to what we saw leading into February, we had a huge spike from December on my particular chart here, and then we saw a massive decline in the amount of available kind of credit out there. And what happened? Markets turned over. So let's go through what's been occurring over the last couple of days. Now, a lot of you would know that I bring up these charts every so often, smart money versus dumb money. It just shows inflows. It's not necessarily a timing tool, but it does help you to understand the psychology of bigger traders versus maybe smaller traders. Everyone's been freaked out recently. Down the low here, we saw dumb money get thrashed all the way down. What happens? Smart money comes and buys the dip. Now, there's a little turn here since the last 24 hours. So we're getting a little bit of selling, and that tends to be what happens. Smart money buys the dips, sells the rips. It's that simple. If they stay high for a long period of time, that means it's sustained purchasing, generally coming from large fund inflows. I will be updating now that we're seeing reports coming out that are actually up to date on fund flows over the weekend video. Hopefully we now get a bit of an idea of what really the big money managers have been doing recently. Smart money versus dumb money is a great concept, but we need to know what the biggest players are doing around the world. And I should have some results for you by the weekend. Let's have a look at the sentiment report here. As we saw, I like to use this as a contrarian indicator. When we were down on our lows only a week or so ago, we saw way too many bears out there. There were way too many puts coming into the third week options expiration and not enough bulls. So we've had a nice relief rally for now, and it's been very strong in particularly the technology sectors. If we think about seasonality, this made perfect sense this year. We saw a sell-off mid-Feb. We saw a pickup mid-March. Well, it does that lead on to further gains. Of course, this is a very common seasonality. We saw a spike in the VIX. Everything kind of happened as we would expect it. And in fact, it's been doing a perfect job for us so far in these markets. We do also know that the third quarter can be very dodgy in the US market. So we've got to be careful. If we do go on epic rallies, we need to be incredibly careful around third quarter earnings, because this is a time where I think issues start to occur, and it could be that kind of breaking of the market at that period of time. For investors, is it cheap to buy markets right now? Well, here we have one of my favorites, which is forward PE ratios. I tend to use this for investment concepts, along with many other reasons, of course. And one of the things here is that we're not really expensive, nor are we cheap. We're basically average. S&P 500 is trading at 17.3 times forward earnings. Now, if we think about it, about 16.7, 16.8 is the average over the last 20 years. So is it cheap or expensive? It's fair. I would say it's fair at this point. So do you want to buy? Yeah, it depends what your plan is and how long your time frame is. If you're a day trader, obviously you don't care about that. But an investor would say it's an okay price. It's not good, or is it bad? If it gets into the 15s again, hey, I'll be talking about it a hell of a lot, because at that point, it starts to get more attractive. So we know that every single Fed cycle in the past, whenever they've rate hiked, they've broken the system and they've kind of destroyed some type of main fundamental in the markets. This time around, it looks to be the banks, because they've been lending to, guess what? Zombie companies, companies that make absolutely no money. Remember back to when you probably first started, 2020, a lot of you out there, I'd be really interested to know as well. Put it in the comments down below. When did you start trading? 2021, a lot of people came in. And in 2021, everyone bought zombies. Companies that made no money, that were getting ridiculous loans. And that is really the crux of the problem right now. Now, we know that the bonds market has been telling us a recession is coming. A quick video will be coming up soon, basically marking the anniversary of yield inversion on one of the major yield inversions, which gets us closer to a potential recession coming through. But during other Fed hiking cycles, they've almost always broken some bank kind of crisis or something in the system. It hasn't always been followed by a recession. So that's something to be important to note, I guess, in these markets. But I don't think that it is like that this time. There's most likely some bad earnings results coming soon. And when those bad earnings results start to come through and we see unemployment start to actually rise again, we can start to say, okay, well, we think the recession is maybe 6 months away or 3 months away. And that should compress earnings. And I'm about to explain why that could compress earnings moving forward. The first thing is, have we seen the bottom that's been formed? We traditionally see the bottom forming with a massive over commitment to utilities, healthcare, and staples. We did see something like this back in October. And as I said, and I promise you guys I will do this, we'll go back over and see whether utilities, staples, and healthcare had an incredible time back last year. They had a pretty good time. Was it incredible enough to mark the bottom in markets? Usually when we're starting to come off the bottom, we see communication services, information technology, and of course, consumer discretionary do incredibly well. That's been happening recently, but is it a false breakout kind of rally? Well, here's the chart that we've used for a while. We're about here at this stage. So let's call it here. We haven't made a new low, and we know that the market is following the no recession path. Basically, the market's betting against a recession, which, you know, the stock market can do. The bonds market's obviously telling us, hey, the recession's coming. It's just a matter of timing. And timing is everything in these markets. So yeah, we haven't seen a recession. But if we do, the standard recession path for markets is to make a new lower low. For a long time, people have talked about 3,200 and 3,000 on the SPY. Are these levels still possible? The simple answer is yes, they are. But it's a matter of when. And we're needing to see the Federal Reserve continuously doubling down on beating inflation while still backdooring, but not too much into the market. Then the market will crack it, because we're going to see a compression in these things. And I won't mention this too much because we've talked about it so many times. We've got forward EPS. If forward EPS turns negative, which it has recently, it's tended to either create kangaroo-style markets or further downside potential. Now, it won't usually trigger until we see bad earnings. Remember, the only time you can really be sure that markets are actually usually in their lows is when good news is good and bad news is bad. At the moment, it's not like that. Bad news could be good for the market and good news could be bad. It's really bizarre. So until you see it actually play the right way around, you can't really be sure bottoms are in. And unfortunately, that often means that you're already 20% off the base when that occurs. ERP is also something that needs to be taken into consideration. I'd suggest reading up on it. We've covered it here several times on the channel, and it's something that is totally not in the market right now. Like, in fact, I think it's probably down here at this stage. It's a bit of an older chart, but ERP, which is equity risk, basically this is a huge component of what happens during recessions. Make sure you mark that. So everyone's FOMOing this idea that the Fed's pivoting and it's all great. Has the market told us the Fed's pivoting? I think so, and we'll talk about that when we look at that chart a little bit later on. But when the Fed pivots, is that even good? Well, they've generally broken something and that needs to be fixed, and that tends to leak into earnings, which tends to cause further declines in the markets. Now, we might not go for some kind of systematic credit risk, even though JP's saying that at this stage, but what we could be seeing is some type of further decline at some point. Now, maybe not in the vicinity like this, but Fed pivots have never been forecasted with excellent, let's say, returns in markets. Usually it's been kind of bad, kangaroo, poor, all of those types of things. Let's have a look at the last 24 hours in the market. It was a bad day for utilities for sure, down 2%. And pretty much any of the defensive market sectors did not get rotated into. Could that mean that we're going higher in markets because these were all hit pretty hard? Gold was also hit with yields going up again, which is obviously quite bad for gold. What did well? Energy. Why? Well, it's as simple as yields made a big switch, and those two are the most correlated at this stage. Banks were also finding some recovery through the session. If we look at the 5-day, you'll see still banks are pretty poor, though on the 5-day, we've seen stabilization thanks to the Federal Reserve on things like regional banks. And in general, we've basically got these out in front: semiconductors, technology, consumer discretionary, and communications. All the things that usually lead the market out of a crash. However, they're mostly being led by, in my opinion, Federal Reserve liquidity that's coming back into the system. This is an update from the last couple of days. Not much has changed except for we've got the curve kind of going back up. So it's more like here at this stage. I will update this chart moving forward as we see the Federal Reserve come out with their statement. And I think there'll be a big move to this trend futures. And this is going to be one of the most important things to be watching. Understanding how yields are affecting asset prices is paramount to, I believe, trading success, and especially multi-month investing, swing trading success. It's a big deal. And it can also help you position. You know, think about what's been one of the best sectors of the last couple of years. No doubt, energy. It's not technology, it's energy. So if you were in energy and you understood the correlation to inflation, you were kicking ass. But recently, energy's been poor. Why? Because we're probably coming up to a sickness in the economy. Let's move over to the VIX. Absolutely no spiking in this thing anymore. It dropped like a rock after hitting 30. A good rule of thumb is 30 and 20 at the moment, or 18 as the low and 30 as the high. That's marked a lot of these bases and tops. I'd like to see a 40 plus VIX to 45 to really show us that we've put in a low. That's usually pretty traditional with seeing a stock market low coming through, and we just haven't had that yet. So here's the chart that's a little bit new. This is the federal funds rate versus US 2-year. And we've had something very interesting occur over the last couple of days. We've literally seen the 2-year crack it and close below and basically say, you're done, Fed. You can't go any higher. Now, when we've had this happen in the past, it's generally meant that the Fed is actually going to pivot. And I think the market knows this, and they're pretty good readers. So while they may have pushed yields a little bit too low too quickly, you can see this is when we tend to see that flatlining Fed pivot starting to come through. So it's unlikely that we're going to have too many more rate hikes. However, to kill inflation, remember, we need to push CPI. So CPI has to come underneath the funds rate. And the Fed know this. I mean, this is a well-known fact within the top circles that unless this occurs, they've never been able to sustainably stop inflation from running away again. Remember what happened in the 1970s. It went up, it came down, they stopped it too quickly in terms of they started cutting rates too fast. Whoa, it had to go back up, and then they had to push really hard and basically cripple the economy to stop it. This time around, I doubt they're going to want to make that mistake. So they're probably going to come out with something like, we're going to pause for a while and look at the data. We're going to look at the data. And you know why that's annoying for traders and investors out there? Because now every data point becomes important again. How annoying. So we're going to have to be on top of the news and all of those things. But this is a very interesting chart. And basically, the bonds market has told us, hey, you know what? You're going to pivot. And they're not usually wrong in this case. They've been very correct, and they tend to get this one right. So be on the watch out for a Fed effectively pivoting. Is that a positive sign? If the markets start rallying and rallying and rallying and they go up wild and you're thinking this is all crazy, that's when you need to be most concerned, because traditionally pivots have not led to great things moving forward for at least a period of time. I expect us to remain in kangaroo-style markets, and the bonds market is still telling us a recession is coming. It's just whether it's 6 or 12 months away from now. Again, we'll do a video on that. Let's move over to the high yield market. So this is where the junk bonds sit. They had a nice green day. And as per our expectation at the moment, the market is stabilized and it's finding buyers. So high yields, well, why wouldn't you like them at the moment? Fed's come out and said, hey, we secure all the zombie bad debt. It's all good. We've got your backs, guys, and people are buying it. Do I like high yields? Absolutely not. I think they're trash. But the thing is that when we see these rally and the stock market rallies, it tends to be more legitimate. When the high yields go down and the stock market's rallying, question mark, whoa, hold on. We need to definitely have the exclamation. It's like in Metal Gear Solid, if anyone's played that game, you know what I mean, when you get caught and the alarm goes off. TLT's not having the best sessions recently. This is because yields are starting to stabilize and they're moving up. For TLT to break this supercritical zone bullish, we need to see US 10-year go underneath 3.32. So if we load up US 10-year, which I'll do right now for us all, let's have a look. There's US 10-year. We need it underneath 3.32. Once that occurs, you'll see Treasuries start to really be bullish. But at this point, that's where we are with the 10-year. It's holding and it's stabilized at this point. So key criticals to be broken here for the US 10-year and the US 2-year, but I think the 10 is the most watched at this stage. Let's move over to the US dollar. So the US dollar stabilized and it came into our perfect area. So it hit the 61.8 fib, it hit into the demand, and it found some buyers. So that's good to see. I mean, it's exactly where you would expect the US dollar to strengthen. Now what I'm doing is if you're thinking, okay, well, I think the US dollar is going to go up because these yields are way too low, they need to go higher. Remember, if yields go up, more desired for the US dollar, then you're looking for the US dollar to break past this blue line here, 103.18. Should that occur, we're probably going to see further resumption of a bullish trend in dollar index for a little while, although it could still be temporary, but it's going to be a little bit of a bullish move. If we lose this level, this green box here, and the bears take full control, I think the market's going to get smashed back down into these 1015s. So we're going to see US dollar continuously decline. A few weeks ago, we talked about this level being the super critical. We brought out some stats that showed us that this was probably short-lived, and that's certainly been occurring. But I like the idea of bullish rallies coming through here, pushing up into these directional zones, these ones here, these supplies. So drop, kind of base, drop, base, drop. So if we rally, we move towards those areas there. And if we lose this position over the next 24 hours, I would be very, very scared. Like that's when you're starting to talk about DXY getting hit pretty hard, I would say, in these markets over the next couple of days into weeks. Let's go into gold. So it did weaken. We suspected as much based on the fact that everyone suddenly thought it was glorious. It's not glorious if yields are going back up, guys. Where do I think gold could get to? Well, I'd like to see it back down into this area here, which is basically that low 1900s. People got super bullish on gold. I totally see why. I absolutely am a big believer. And I still think gold goes to $3,000 an ounce. But the problem is I've got a massive time horizon on that, 2 to 5 years. That's not easy. It's going to revolve around a Fed pivot, huge cuts. And, also the manipulation of it being so low for so long. If you go and push a gold chart out massively, you'll see it's been down and basically sitting here for a long time. And if you keep pushing it, you had the data, you'll see it just cannot get past $2,000 an ounce for a very, very long time. So where's gold going next? At this stage, it does look weak. Of course, it depends on US dollar a little bit and yields, but I think this is the critical zone, which sits around 1910. So I expect maybe markets to do something like that. It really depends on yields. It's in the middle of nowhere land at this point, so be careful there on gold. Let's move over to copper. So copper finds itself at critical resistance, with this being the supply. Again, moving into yields. So many markets hitting at criticals because this is what they do. Now, I wouldn't trade copper personally, but as you know, I'm a big fan on seeing this weakness and then going and attacking a few other markets. Recently, I attacked iron ore markets and minerals because I saw what I was seeing on copper. I'd like to see copper continue to weaken because it would be in line with our thought processes towards 370 at what I would call critical resistance at this point. So certainly a big zone for it. Natty gas, nice little rally coming off the low there. It did end up engulfing back. Look, natural gas is probably an accumulation. We'll leave it there for now. US oil had a great 24 hours. Let's have a look at this on the smaller time frames. So it came up and it hit this level, this good resistance. Great little inverse here. Head and shoulders moves in. Now we're looking for it to breach this probably a little bit better than it did. But I could see buyers recommitting somewhere around 67 for this at the moment, around that 67 level. It really comes down to yields again. But look, oil is in that critical buy zone. I'd suspect oil to do something like this and then maybe move up through that later on. But I am hoping on big things for oil in April and May. We'll find out whether it can do it. And of course, we'll revisit this one. Let's move over to Tesla now. Big day for it. Absolutely slapped through this level. Ended up doing 7.82%. So it was a breakout day for Tesla. It didn't short anymore. It just managed to it literally just gapped straight through it. So it gapped through here and it rallied with the rest of the market. I'm still mostly negative on Tesla. Where has it gone to? Well, it's gone to the next level, which is, of course, the full fib down. So you're seeing critical level again being reached ahead of the news. That's how it got there. This is the next level. So once it broke through here, the next level is here. If it breaks through here, the next level is up here. So it's done a good job. It's back to that 61.8 of the whole low. It's back to this level here, which basically took the market down. And I still have faith that eventually we'll move down into this zone. But again, timing is everything with Tesla. So did we pick the right rally? Yes. Did we see the turn? Absolutely. Is this area critical? It was. But then when this market came out bullish, that on the previous session, it was just a rally. And everything was going bullish. And we saw that across all the market. Let's have a look at Apple. Now, this is almost, hit options expected weekly highs. But is this signaling further bullishness? Kind of looks like it. Apple broke. It smashed this reaction level. It's closed above, and we know there's a gap fill here at 163.36. So could we be looking for a bit more rally here in the markets thanks to the Fed injection to freak everybody out, and then we hit criticals on the S&P? We'll look at those levels soon. So yes, no doubt, at this stage, Apple moved through a super big zone. And if it holds that weekly above, as you can see, it's a big break. This is no kidding, this level. And of course, we've got that gap that could be filled. So if you look at something like a 2 hour and you zoom it out, you'll see there was a huge gap that was left behind that was never properly filled. So that's 163.36 on Apple. And it does pose a pretty nice bullish story for it. Let's move over to Nvidia. A lot of people are trying to short this. No signs yet, guys. Absolutely not. We've got a gap fill. We're sitting around up here creating stuff. We've got expected weekly options highs. If Apple's anything to go off, maybe this market continues to rally. Look, this is unrealistic in terms of the gains that it's had. So it's 88% off that low. It will have a pullback. But again, timing is everything. So the longer and harder this goes up, the more brutal the sell will be. Just like it was last time, brutal sell-off, yeah. But we have to be patient. And if you want to go against it, I don't go against something that's rallying such as that. Consumer discretionary versus staples had a good session. This means that the market was feeling a little bit more bullish about the world, so certainly something to watch out for. DAX did pretty well as well, came back up. Still pretty negative on the DAX myself. However, that's a nice turn. So we'll have to see whether it can hold this through the federal funds reports and everything. It broke the trend line. I guess I'm kind of indifferent here more than anything else. But yeah, this is a fairly critical zone. You can see the previous supports, resistances, everything that's going on. Australian markets holding up well for the Australian viewers out there before we go into the American indices. And you can see a little inverse head and shoulders here on the 2 hour. It's holding in a nice level of demand, which was always our box. So yeah, it's looking okay for now. And we'll see what happens over the next 24 hours. Let's move over to the NASDAQ. Now the NASDAQ came to this is the futures market, but you can see here the NASDAQ coming straight up into these highs. So this is where it's at, yeah? I mean, NASDAQ is at the reaction levels. So great, strong session, even stronger than I thought the session would come out with. I was certainly bullish, and I even thought we'd get here. But yeah, nice, strong session. I thought it might take part of the session moving forward into the central bank decision. Then we would hit this level, and then just around 2 p.m. to 2:30, we'd be pressuring this zone. So we're pressuring it early, and the NASDAQ showing that. Let's have a look at the Russell 2000. So again, nice breakout here of the downward trend, testing those levels. 1780 to 1800 was our previous call. We're finding that, and again, we expect to be there into the funds rate decision. Here is the Qs. So you can see the Qs again coming up to that critical resistance. This really marks a huge overperformance, though, of certain stocks. So if you look at like Apple versus the SPY, what you might notice recently is that there's a huge outperformance of Apple. Look at that. Just phenomenal outperformance by the big stocks. Now, in the past, I'm not sure if this is super negative or positive, but certainly people are stacking into the big companies. And as a comparison, you can see here that Apple is absolutely outperforming and doing very well off the low. Let's move over to the SPY. SPY's through the expected weekly options high. I never expected those to hold. I'm pretty surprised they were so tight. 400 is one of the most traded levels of the market. So 400, 400, 400, 400. It's critical for the US 500. Here's the gap that we now got filled, or we haven't filled, which is 39.51, a very interesting level. And you'll notice that we've marked between that 39.75 and 4,000. These two levels are super critical. Unfilled gap up here. So we get to the S&P 500. What happens next? Well, there are two major bear zones. There is a news comes out, flicks 40.16, then sells. If that does occur, you've got to be pretty nimble and fast, I think, as a day trader. Or is it more likely that we actually move up to here? And this being the critical zone, being 40.80, 40.90, gap fill, all sorts of things going up on here. I like both. I know that basically 4,000 or 4K is one of the most traded levels. So it presents exceptional equilibrium for the markets over the long-term time frame. And I like the idea that these levels could be faded. Now, where are we with the US 100? Super critical resistance. Where are we with US 500? Most traded zone for a long period of time. So if we swing, remember, often the first news reaction is the wrong reaction. So if we look at the news and how it's coming out, we've got the 2 p.m. rate, then we've got the 2:30 p.m. kind of let's have a chat about it. Now, when we have a chat about it, that's usually the adverse or the opposite reaction. Not every time, but certainly the way it tends to go. So I think that for bears, you're going to be wanting to be patient, sitting at these levels, sitting at key zones. I've put them over on Twitter as well, just key levels that I'm looking at, of course, just potential. If we get an initial sell-off, so the first move's the sell-off, I'd be looking for that gap to get cleaned up and then potentially buyers to recommence. And that will make it more of a proper fill on the way up. Because if we look at the SPX at the moment, if we check that gap, that's not really great to leave behind in this market. So if the first move is down, this could be where the buyers recommence, and I'd be looking for small time frames. If the market first move is up, 40.16, if the first move just skyrockets through and there's no turn, then I think 40.90 is the next zone. I'm open to both ends, and at this point, we're moving with the Federal Reserve liquidity. That's just the facts. We're looking at that. Let's move over to Bitcoin. It's holding well. I like Bitcoin to 30,000 200, that is. I'd like to see it hit that zone after breaking through 25.2. Our main reasoning was towards 30,000. So I don't see any weakness in it yet. We'll find out from the Fed meeting, but basically it's doing its thing and it's dancing its way up. Let's move over to the news coming through. 2 p.m. FOMC economic projections, rate statement, and funds rate. 25 basis points is the expectation. Then we move to the press conference where all the tools and this and that, and probably my guess would be mentioning data a million times and how they need to look at the data and they'll be focused on the data and everything comes out. But that'll be an interesting one. And then we go through the rest of the week and we have a lot of European news coming. And then we've got Flash Services PMI coming 9:45 New York time, Friday, March 24th. We also have a bunch of daylight time shifts coming through this weekend, so make sure you're aware of that if you trade from overseas. We have a lot of overseas members, and obviously I love you guys in the community. So from wherever you are in the world, you got to be on top of all these random time changes that happen. If you're also interested, we are doing, of course, the giveaway is going to be drawn tomorrow. I had a couple of issues with some sneaky people out there. And I know who you are. Very sneaky, trying to enter 150 times. But anyway, we'll I'll clean that up to make it fair for you all. So we'll do the giveaway on tomorrow's video. But yeah, if you're interested, follow along. Make sure to get those cheat sheets. We will be getting some extra information out to you as well. Follow us on Twitter, anything else. And if you're interested in one of our courses and more of how we structure up the market, do remember you can do so with the links down below as well and visiting our website. So thanks so much for watching. Subscribe, smash that like button. We'll see you in the next one and stay safe out there. It's sure to be a very interesting event with a lot of yield curve switches. Bye for now.